being an entrepreneur sounds cool, but the reality of building a business is very, very difficult. Every level that you hit, there's a lot of things that suck that you just won't want to do. What you're capable of is on the other side. I don't feel like it.
And if you're committed to what it is that you're trying to do, nothing is going to stop you from getting there.
Welcome back to another episode of Real Business Owners with myself, Trevor Cowley. Guys, I have to put a disclaimer on this episode just legally to protect myself because I'm going to be giving you guys a lot of information today. This is some stuff that I went over with my inner circle. I just felt as though that it's important to discuss with you guys as well. You know, I want to see you guys win. I want your money to stay where it belongs. And that's with you. You know, you worked hard for your money and you should keep as much money as you possibly can because the IRS is not going to reach out to you and say, hey, by the way, Bob, you missed this tax deduction. They don't really give a shit. Now, if you underpay, they'll sure as hell reach out to you and say, hey, you owe us X amount, right? And so they're great at informing you when you underpay, but they're definitely not going to reach out to you because you're overpaying. And if you overpay, part of it is your fault. You have to take some accountability here, right? It's your money. Nobody's going to care about your money like you should care about your money. And so I'm going to go over some strategies. I did this with my inner circle a couple weeks ago. I wasn't going to do this podcast because I felt like it was important to keep it in the inner circle, but at the exact same time, I just hate seeing hardworking business owners lose out on opportunities to keep as much money as they possibly can. So this episode, technically, it's not financial advice. The whole idea of this episode is to give you the information that you need so where you can go to your accountant or your CPA and have the ammunition to have some of those discussions and say, hey, why aren't we doing this? What about this? Could we try this? How would this apply to my current situation? And so most of the time, they're not going to be that proactive with you and say, hey, if you would have done this or this or this, you could have saved a bunch of money. And you have to understand that most of the time that when you're paying an accounting firm, you're paying them, if you're paying them for tax prep, that's what you're paying them for, to prepare your taxes, not to give you tax strategies. There's a whole different department for that where you actually pay for a tax plan. A good accounting firm should be proactive with you and reach out to you. For instance, right now, we're in the fourth quarter. So what we've done is we've built a list of clients. Anybody that's paid 20 grand or more, we send an email out to them and saying, hey, we saw that you paid X in taxes. If you're interested in discussing some strategies that would reduce that for this next year, just reply to this email and we'll touch base with you and talk about what that looks like. Our tax plan, and the reason why we structure it this way is to give people peace of mind. We charge $5,000 for a tax plan with a warranty that will save you a minimum of $6,000. And some people might say, well, that's only 20%. That's not that big of a deal. The idea is that's the minimum, right? We want to make sure that you get at least a 20% return, but year after year, if you keep executing on these strategies, you have the ability to save, again, if we hit the minimum, $6,000 every single year. So at that point, you're getting 100% return plus on an annual basis. The first year, it would just be 20%. If we don't hit our warranty, we refund down to what we did save. So for instance, if somebody spent $5,000 with us and we only saved them $4,000 in taxes, we would refund down to $4,000 plus an extra $1,000 to make sure that no matter what, they come out money ahead, that it's a positive experience. The last thing that we want to do is charge something that somebody's not getting value from. And, again, as I've took over the accounting firm over the last 6 weeks or so, I'm just absolutely impressed by the way that the team operates, how they work with each other in a manner that is super positive, just collaborating as a team in any situation that they possibly can in order to do whatever is best for the client. And I will say, we did an incredible job when we first started the company and as we were expanding, but we did hit a point where, we hit a rocky road because we expanded so quick. The fact is you're either worried about one of two things as a business owner. It's very difficult to balance both of these. You're either worried about generating revenue to the point where you overwhelm your fulfillment team and then quality starts to diminish, or you're more worried about quality. And that's where we're at right now. We're more worried about quality than we are a high volume of sales. And the idea really is to do an absolutely incredible job for people so that, we have the ability to retain them for a long period of time. If you're putting money over quality, you're going to experience a rocky road. And, my background is obviously sales. My partner's backgrounds were sales. And so we focused on sales a little too much and overwhelmed fulfillment to where quality dipped. And that's why we brought the CEO in to change that. And now that I took over and came back in and see the systems and processes and everything that we have dialed in, we have numbers specifically that we can only onboard X amount of clients in order to remain at this level of quality, right? So you should have numbers like that. Based upon the staff, we can handle X. And once we get up to X number, we need to bring on X more staff so that we can continue to onboard X amount of clients. And you should have some of those numbers as well with inside of your business. But let's jump into it. Let's jump into some of these things. And so I'm going to start, with some of the basics and then I'll kind of work my way down the list. And so if some of this stuff is already familiar to you, cool. But I believe some of it will be new information. Maybe it's 50-50. I don't know. Again, this is not financial advice. It's here to equip you with ammunition so that you understand what the right questions are to ask whoever's preparing or filing your taxes, or at least reaching out to them to discuss a potential tax plan. If you don't like your current accountant or CPA, just touch base with us here at Easier Accounting. Send me a DM. I'd be happy to work with you guys. LLC or S corporation. That's kind of the first thing. When's the right step to go from an LLC to an S corporation? The reason why it's okay to have an LLC to start is because you're not required to put yourself on what's known as a fair and reasonable salary, and an S corp does require that. When you're starting out, you usually don't have an abundance of money. Therefore, you really can't afford to be putting yourself on payroll, paying yourself a fair and reasonable salary, while you should be putting the company first and reinvesting that money back into the business. The problem with an LLC is it pays self-employment tax of 15.3%. So when you used to be an employee, you used to pay state, federal, then there was Social Security, and then there was Medicaid or Medicare. And that Social Security and Medicare, that was 7.65% of your check, whatever you got paid. Your employer has to match that 7.65%, which totals 15.3%. That's called your FICA tax, okay? With an LLC, you have to pay it in that same 15.3%, but they call it self-employment tax. So if you make $100,000 a year, you could be paying $15,300 just in self-employment tax. The idea is once you get above roughly, the number is $60,000, and the reason why is because an S-corp tax return costs more than an LLC. Also, if an LLC doesn't require you to put yourself on a fair and reasonable payroll, you don't have the expense of having to pay a payroll. In other words, payroll softwares cost money, things like that. So the idea is it should actually be saving you money, but anything when you're starting to talk about under $60,000, because you have to put yourself on a fair and reasonable salary, it doesn't make sense, because when you put yourself on a fair and reasonable salary, that means by default, you're the employee and the employer. So let's say you made $60,000 and you paid yourself $2,000 a month or $24,000 a year. The rest, the $36,000 would come out without the self-employment tax. But you're only talking about saving 15% on roughly $30,000, which is $4,000 or $5,000 in tax savings. By the time you pay for the S-corp tax return, by the time you pay yourself and have the expense of having a payroll, it starts getting to the point where it's pretty close to break even. And you have to actually track what's called corporate minutes for an S corporation, which is not required for an LLC. So there's a little more heavy lifting with an S corporation, but when you hit the right income level, it starts to make sense. That the exchange starts to become worth it at that point. And so that the rough number, again, not financial advice. You need to talk to somebody about your current situation. Is roughly $60,000 or greater. At that point, you would want to talk about electing to have your LLC taxed as an S corp, where your EIN, your bank accounts, all that stuff stays the same. You just file that election, and the IRS then taxes the LLC as an S corporation. You get the tax benefits of that. So that's how that works. When you do set up the S corporation, let's say you're making $100,000, like I talked about the example where you would pay $15,000, $15,300 if you had an LLC versus the S corporation. Let's use that same example. If you made $100,000 through the S corporation and you put yourself on a fair and reasonable salary, again, let's say $24,000 a year, depends on what your duties are, depends on what state. In some states, the minimum wage isn't even going to get to the point of $24,000 a year. So you got to be careful about that. That's why you need to get advice from somebody about your exact situation. Minimum wage in the state of Utah, I believe, is still $7.25 or $7.50. It's one of those two numbers. It's extremely, extremely low. So it makes sense here. But in the state of California, if the minimum wage is, $20 an hour, I don't know what it is there now, but that's $800 a week. That's $3,200 a month. You're starting to talk close to $35,000 to $40,000 a year. So paying yourself a fair and reasonable salary of $2,000 a month in the state of California might not make sense. It could trigger a red flag. So again, every situation is going to be unique. I'm just using this stuff as an example to empower you. So let's use the same scenario, $24,000 on $100,000. You're pulling out the other $76,000 without that 15.3% of self-employment tax. But you would still have to pay the 15.3% on the $24,000 because, again, you're the employee and the employer. So you're paying the FICA tax, Social Security and Medicare of 7.65% as the employee, and then as the employer, you're matching it. There's that 15.3%. The government's going to get their money regardless. The S Corp is just more advantageous depending on what your income is. So you're only paying 15.3% on that first $24,000, and the rest comes out without that self-employment tax. In other words, without that 15.3%. So again, I could go deeper into some of this stuff, but for the sake of time, it's just here to empower you. If you make over $60,000 a year and you're still set up as an LLC, that's something that you're going to want to check out. You have 75-day window, and that's the reason why I wanted to record this podcast, because this window is coming up. You have 75 days from setting up your LLC to elect to have it be taxed as an S Corp, or you have the first 75 days of each year, right? So January 1st through March 15th of every single year, you have the ability to make that election and switch how you're ultimately taxed. But again, that would require a fair and reasonable salary. There's some stuff that would just need to be set up. But if you're talking about saving $7,000, $8,000, $9,000, it's worth going through a couple things to get set up in order for you to keep some of that hard-earned money that is deservingly yours. Okay. So now that we got the entity stuff out of the way, and I want to move on to, some actual strategies as well. I do want to bring up one thing before I go into the strategies. If you're somebody that, is filing late, usually if you owe money, there's like a late filing fee, there's interest, there's additional penalties. If you experience that this year, or if you ever experience that, there's what's called, most firms aren't going to talk about it. They just say, hey, this is what you owe. You're going to get a letter in the mail. They're going to say, hey, your fees, penalties, interest, all that stuff for filing late or paying late is $12,000 or whatever that number is. And then you're left to pay that. There's what's called a first-time abatement with the IRS. It's a form that you fill out, and you could send that in, and you could ask them to basically forgive you for your sins, I guess, let's call it, right? For filing late. Now, if you pay late as well, usually there's not forgiveness on the interest of paying late. In some cases there is. You just never know what you're going to get with a first-time abatement, but that's just a clever thing to know, provided you're ever in a situation and you owe taxes and you filed late and you paid late. Talk to your accountant, CPA about the abatement. If you've never filed for it, usually you'll have some success there. But it's never guaranteed with the IRS. But we've had a lot of success in helping people that just don't seem to get us their stuff on time as we're requesting it. And then we do what we can to try to ask for forgiveness and then hold them accountable, saying, hey, next year we're going to need this stuff sooner. we pulled that card out, we used it. We're probably not going to be able to ask for forgiveness again, right? At that point, they know it's just you just being not diligent and doing what you should do. So the first time they'll maybe turn the other cheek. But so a couple things that I want to go over with you in regards to just a few strategies. Obviously, the LLC is somewhat of a strategy, switching that over to an S Corp because it has the ability to save you, again, anywhere from $5,000 to $15,000, depending on where your income is. And you're going to want to figure out what that right number is. The more money you make, the more you're probably going to want to pay yourself in a fair and reasonable salary. You don't want to exceed like 130,000. I think it's 130, 135. Again, don't quote me on it. That's why I have to say this isn't financial advice, because that's where the FICA tax kind of, if you continue to pay in, they only give you credit up to like 130 or 135, somewhere around that number. So in other words, if you're contributing to Social Security so that you have the ability to see that later on in life, but you paid in $150,000, you're not getting $150,000 in credit. You're only getting up to that specific number. So when you put yourself on a fair and reasonable salary, if your income's extremely high, you don't want to exceed that number because you're not getting any value out of it after that. So just be aware of some of those things. You have the ability to set up a SEP IRA, and you can contribute up to 25% of your income pre-tax, right? So let's say, for instance, you made $200,000 last year or this year, let's say, and you know that that's what you're going to make, and you still have a couple months left. You could set up a SEP IRA and contribute up to $50,000 into that. The max that you can contribute pre-tax is up to $70,000. Okay. So if you get to the point where you make $1 million, you can't contribute $250,000 and bring your income down to $750,000 where you're only paying tax on $750,000. The max is $70,000 on an annual basis, or again, up to 25% of your income. If you make $100,000, the max that you can contribute to it is $25,000. But if you made $100,000 and you contributed $25,000, your tax liability would only be on the $75,000. Then if you utilize the S Corp strategy and brought that down even more, I mean, you're starting to whittle it down where you're really not paying any tax, or it's heavily reduced. The Augusta rule. The Augusta rule is where you can rent your personal property for up to 14 days per year tax-free. Your home is a part of your personal property. So when you set up an entity, there's a reason why it gets an EIN. You as a human being are an entity as well. You have a Social Security number. That's your identification number. Your entity has its own identification number. That's why you file a business tax return and then a personal tax return. So it is, in a sense, it's not in a sense, it is its own entity, right? And you could treat it as such. You're two different entities. So therefore, if you can rent your personal property for up to 14 days a year tax-free, that by default means that you have the ability to rent your home to your corporation and pay yourself directly in terms of renting your home to your business, and you get to take that money personally and not have to pay any tax on it. You want to be careful about this one because I've had a client before come to us and it was like $52,000 that they contributed or utilized the Augusta rule strategy, but their mortgage on the house was like $3,000 a month. So they paid more than their mortgage on an annual basis. The idea is to use strategies, but not necessarily abuse them. You don't want to create red flags for yourself. So we had to advise that individual that that's not something that we think is a smart thing to do. The idea really is to look on like Airbnb or VRBO to see what a home that's similar to your home would rent for. So if your home would rent for $200 a night or $300 a night, or if your backyard's beautiful and it could be a wedding venue, how much do wedding venues, things like that. And that's what his argument was. Well, wedding venues charge a couple $1,000s or $5,000 just for a one-time use. And it's like, bro, people aren't going to use your house for a wedding venue. So, I mean, apples have to be apples here. You've got an apple and you're trying to tell me that it's a banana, and it just don't work like that. So, be strategic about it. Don't be dumb about it. So renting your house up to 14 days, let's say it's 200 to 300, let's say it's $300. That means you could cut yourself a check roughly for $4,200 on an annual basis, and you don't have to pay any tax on that $4,200, right? So I mean, it's not crazy, it's going to save you $1,000, $2,000 or so in taxes on something like that, unless you have a home that would rent for $300, $400, $500 a night. The only way that this could potentially be manipulated by a human being is to look in their area at peak season and say, hey, this is our peak season. We live near the beach and it's rented out in July at $800 a night. Then as long as you have proof of that, screenshots of that, and you feel as though that's a valid argument, which I would say it is a valid argument, then you could utilize a number like that and increase the number in terms of which you're saving dramatically with a strategy like that. But again, use it, don't abuse it. It's a strategy, and take advantage of it. But you could do corporate meetings at your home. You could do company parties at your home, or barbecues, or whatever you wanted to do. But you can't just straight up just cut the check and just say it is what it is. I rented the house to the corporation. The idea is to have good documentation of some of this stuff. If you ever got audited, you have the ability to verify some of that stuff. And so another thing is when you first set up an entity, some of the things that you would utilize as an everyday expense just as a human being, you could start wrapping some of those things up as a tax deduction. That's one of the advantages of being a business owner. Like, for instance, if you have a home office, you can rent up to 300 square feet of your home as a home office, so to speak. So, or in other words, deduct it from your mortgage. So if you have a 3,000 square foot home, that's 10% of whatever your mortgage is has the ability to be deducted from your home office. So if you're paying $3,000 a month for a 3,000 square foot home, you get to save $300 a month, which is $36,000 in terms of that home office deduction. With that means 10% of your internet, 10% of your utilities, anything that lands underneath keeping that home up to speed. In other words, functional or operational. You now take whatever that percentage is of those other bills and can wrap that up into a deduction as well. Same thing for a cell phone. If half your cell phone is used for business, or 75%, and you pay $200 a month, and $100 a month is a tax deduction. Most business owners just throw it all on there, but technically it's called percentage use. What percentage of business did you use with that cell phone? Or same with a vehicle. If you buy a vehicle, did you use that vehicle 50% of the time for business or 100% of the time for business? You have the ability, Trump put that back in play, where you could buy a vehicle or a piece of equipment with inside of your organization and write off 100% of it on year one. So if you bought a truck that's $100,000 and it's over 6,000 pounds is the requirement, then you have the ability at that point to deduct 100% of it. And then everything year after year, you have the ability to deduct if you get new tires, any of the maintenance, oil changes, servicing, anything that encompasses, keeping that vehicle on the road and moving, has the ability to be a deduction after that year when you take 100%. Now, if you use a vehicle and you say 50% of the times for business use, then 50% of the tires, 50% of the oil changes, 50% of any maintenance that's associated with that vehicle now is also a tax deduction. The problem with most of this stuff, guys, nobody tracks it. Nobody does a good job. They don't hold themselves accountable. They just kind of go about their business. They're so stressed out. They're focused on, just keeping their business afloat that they really don't track a whole lot of this stuff. Therefore, they end up overpaying in taxes. And the fact that you're fighting to keep your business afloat, or if you're struggling financially, that's all the more reason to actually take some of this stuff and apply it so that you can keep as much money as you possibly can. But the fact that you're stressed out and you're so focused on that, you're ignoring money that you have the ability to put in your pocket through some of these tax strategies. If you actually create a strategy for these strategies in terms of tracking some of this stuff and documenting it properly so that you could take advantage of it. Paying your kids, same thing. I mean, there's this stuff. Again, you need to discuss this stuff with whoever's preparing your taxes, because there's certain accountants or CPAs that just don't feel comfortable doing the Augusta rule. They don't feel comfortable putting your kids on payroll. It's like two basketball players. Yes, they're both professional basketball players, but that doesn't mean that they're created equal. One has a different skill level. One's more comfortable on the free throw line. One's more comfortable underneath the hoop. One's more comfortable behind the 3-point line, right? LeBron James is not the same as, some rookie that doesn't have any experience, but that yet they both play basketball, meaning not every CPA or accountant is created equal. They all have this thing called their perspective. And whether it's right or wrong, it is their perspective, and they're just going to do whatever they feel comfortable with. What you need to realize as a business owner is these CPAs and accountants, they basically come to an agreement and sign an agreement stating that they're going to be honest. And if they're caught doing something that they shouldn't be doing, they have the ability to lose their ability to generate income for themselves. In other words, prepare people's tax returns. And so a lot of the times business owners are going, hey, let's get creative. What can you do for me? And it's like, they only have the ability to go so far and advise you so far. That's why it's important to be equipped with information. And some business owners are like, oh, well, I did this, but can I write it off? And they're going to say no. But if that same expense you said, this is what I used this expense for, this is what it was, and you put it under a business deduction, then they write it off, because on your tax return, you sign something basically relieving them of liability, that the only thing that they did is take the information that you gave them and implemented that in the tax return. And that information is valid or true, and they don't really hold liability for that. Now, if they're aware that you're trying to cut a corner, then it does fall on their shoulders. They can't advise you to do something that's improper. And I'm not advising you to do something that's improper. I'm just telling you, business owners are just very green and just think that if they openly, hey, I want to try to write this off, or how can I do, 99% of the time it's just not going to happen, because they signed that saying that they're not going to cross that line, so to speak. And they don't want to lose their right to, generate income for their family and feed their families. And so, especially just for one person, you might think you're special. You're not special enough for them to risk their license in order to save you, a couple grand in taxes. So just be aware of that. Paying your kids. So, I mean, there's a lot of gray area around this stuff. There's no minimum age. There's Gerber babies that had existed on those little bottles, or, Huggies on the diapers. I'm sure they're getting paid for their image and likeness, right? Or their parents are getting paid for that image or likeness. And so it's the same concept. It just has to be documented properly, and they have to be legitimate things that they're doing in your business. If you're a real estate professional, then and you utilize your family photos on billboards, and it's on your business cards or slapped across the side of your vehicle, then obviously you have the ability to say, hey, for marketing reasons, I'm using your image and likeness on billboards, on my car, on my business cards, whatever it is. You can pay them up to $15,000 a year. As long as it's through an LLC, it's tax-free, right? And then what you would do with that money is obviously you set them up a bank account, and you're the custodian, so you have full control over that money. I'm not telling you to take that money and transfer it over to yourself, but that doesn't mean that you don't have the ability to either. But really, the true idea is utilize any expenses that the kids have, sporting activities, school clothes, vacations, trial, anything. Now, some of these things, because you paid them, they can pay their own way through some of those activities or some of those expenses that every kid's going to have. And they have the ability just to, again, just pay for themselves in that regard. So, last but not least, and again, there's more strategies, guys. There's a ton. You could look at what expenses, for instance, our rent here is $16,200 per month. If I wanted to pay, $185,000 and just take care of next year because it's an extremely good year and I want to reduce the profit margins on the books by almost $200,000, I could pay for next year's rent up front in December and reduce the overall income that the business had. In other words, the K-1 that you would receive that you got to pay tax on is now lower. So if you have expenses that you're going to have anyways, and you're having an extremely good year, you could prepay those expenses, but that falls on the books this year and has the ability to reduce your tax liability. Every business is going to have ups and downs. And so if you have a good year again next year, you can do the same thing. And then when you find a year that's kind of a lower year or a down year, you don't have to prepay that, right? Because you're not going to have to worry about, overpaying in taxes or trying to save a bunch of money on a down year. So that is a strategy you could do. Some people like it, some people don't. Another strategy for high income earners that want to think about their future is a cost segregation study. So if you're thinking about your future and you want to be making investments into real estate and that's something that you've thought about, then this strategy is an excellent strategy because you have the ability to buy a rental, do what's called a cost segregation study on that rental. And when they get done with the study, it depends on who you go through. It can cost anywhere from $2,000 to $5,000 if it's an apartment unit. If it's a bigger unit, it has the ability to be $10,000, $15,000, $20,000. Again, the prices are all over the place depending on who you utilize to do a cost segregation study. If you own rental properties and you've never done this one before, I have an individual. We don't do cost seg studies internal, but we do work closely with somebody that does cost segregation studies. I do also work closely with a buddy of mine, Andrew Ammons. He was on the podcast recently. If you're a high income earner and you don't know what rental property to buy, you want to make sure it cash flows and you don't really want to manage it. They have a property management company and a housing development company where they develop the houses, they put renters in it, and then they sell you that property with renters already in it so that the mortgage is already paying for itself. And then they manage that property for you as well. So it's completely hands off. You have the ability to go that route as well. And if you need a connection to a cost seg guy, or if you need a connection for, rental properties that have the ability to cash flow and appreciate in value over the course of time, thinking long-term about your long-term wealth strategy, that's a good strategy to have. The only caveat to the cost seg stuff is you have to be what's considered or known as a real estate professional, which requires you to have a minimum of 500 hours on an annual basis in real estate, which is roughly about 9 to 10 hours per week, where you would have to be doing something that's regarding real estate, whether you're checking out new properties or whatever it may be. You would want to, again, properly document as much as you possibly can in terms of the hours that you spent with inside the real estate sector. But if you bought a rental property, let's say from Andrew Ammons, it's $250,000, you can do a cost seg study. You usually get 20 to 30% on year one. So if somebody bought a $300,000 rental and it's at 20%, you get a $60,000 savings right off the bat, right? And if you're paying, 25% or so in tax, you're talking $15,000, $16,000 comes right off the top of your taxes is what you end up saving. And so that's enough to cover your down payment on the rental property. And then the rental property just pays for itself because there's a renter in there, and then it appreciates with over time. And that's a good wealth strategy to implement, and a reduced tax strategy. I talked to somebody 2 or 3 days ago. This lady has like over 100 properties. I said, you ever done a cost seg on any of these properties? And, what's a cost seg? Had no idea, but her CPA has never even brought it up. And I said, that just means that he's a data puncher. He's not trying to be proactive. He's not trying to save you money. You probably never paid for a tax plan where they can sit down and look at your situation, look at all the things that are available in the marketplace in terms of strategies, and talk about implementing some of these things. Her greatest property was like 22 units in this apartment. She's paid $3 million for it. So if she gets 30% on year one after doing a cost seg study, that's $900,000. And if she's making the type of money that she's making, which she is, you're talking 30% type tax bracket, 30% plus type tax bracket, 30% of $900,000. I mean, that's a lot of money, guys. You're talking about, close to $300,000 in tax savings by spending 20 grand just doing a cost seg study on that one piece of property. And she has a bunch of other ones. Well, I don't want to pay for all of them. I said, you don't have to do that. You can use one every single year and continue to do it year after year, but you're only paying on one cost seg study a year to the point where you can reduce your tax liability down to zero. So that's a good just overall wealth strategy to reduce your tax liability and take the money that you're saving in taxes that's used as your down payment or to pay down some of the real estate, so that the cash flow that you're getting off of the real estate only increases, where you're no out of pocket in order to purchase it because it just came right back to you. So you're not technically spending money. If you zoom out far enough, initially you're spending money to buy it, then to do the cost seg study and doing all that. But you zoom out far enough, all of that just paid for itself by executing a cost segregation study. And so these were just some things that I just jotted down. There's a whole list of different things that you have the ability to do or leverage in order to, again, keep the money where it belongs, which is in your pocket. You work hard for it. If any of these strategies are useful to you, make sure that you share the video or share the podcast. Recommend it to somebody that you know that is a high income earner. Or recommend it to somebody that you know is a high income earner. And if you are sick of your accountant or CPA and they're not doing a good job or being proactive with you, reach out to us. We'd be happy to help. Per usual, guys, kick ass, and we'll see you guys next week.